So as we saw, the Troubled Asset Deferral Program, which was part of the CARES Act, truly permitted banks to kick that can of default down the road. All of that is going to come home to roost over the course of the next 3 or 4 quarters. As banks start to have to deal with that, there's going to be an impact. Whether or not that impact is felt immediately or whether there is new guidance, which we'll talk about in a moment, that allows them to be a little more, let's say, forgiving to avoid defaults, is going to have a big impact on how the economy is going to perform over the course of the next, let's call it 12 to 24 months. You also have to remember that the Federal Reserve has indicated this year that they're going to raise interest rates a minimum of 3 to 4 times. These are expected to be relatively significant increases, with some, including the president of JP Morgan Chase, predicting at least 7 to 8 increases. If they have half-point and full-point increases, that is going to have a major impact on property values, lending rates, and how many people are going to be in the market to buy assets in the first place. What you've seen is so many people who have assets right now that really aren't willing to sell are kind of being compelled to sell because prices are so high right now. And that's really an abnormal situation. So as you'll see later on, we're preaching patience. In the last crisis, when the Fed began raising interest rates, and Alan Greenspan raised interest rates 17 consecutive quarters, it basically threw the brakes on the economy in a way that caused a major impact. And you saw values decline, market demand plummeted, and the availability of financing simply wasn't there. In fact, most banks were not open to commercial lending for a period of 12 to 24 months. And as players started to come back to the marketplace, the terms of those deals were dramatically reduced. Lower loan-to-value ratios, higher debt yields, all of those things meant that you had to put more capital and more equity at risk before getting started. Now again, many folks have forgotten what went down just 15 years ago when the Fed really started raising those interest rates. Banks were forced to then have to deal with assets that weren't able to cover their debt any longer because the cost of their debt went up. Now heading into COVID, the banks weren't in fantastic shape. In fact, it was recently announced, and unfortunately there was almost no media coverage of it whatsoever, that there were nearly $4 trillion in Federal Reserve loans made to the top 20 institutions. We're talking about JP Morgan Chase, Goldman Sachs, and Citigroup. They had to take $4 trillion in debt on to go ahead and fund their repo loan department prior to COVID-19. This was the 4th quarter of 2019. And then we got into the pandemic, which has completely set the market askew. All of these things are going to have to come back into legal compliance unless there's some action once again. So how did we get here? During the last cycle, Class A retail, office, and hospitality were the gold standard. They were the blue chip investments that went into the commercial mortgage-backed securities market. These were sold off. And we were supposed to have learned the lesson of what went wrong during the last financial crisis, the real estate market meltdown, and really the global financial crisis. But we really didn't learn that well. In the beginning of the last decade, most of the debt that was placed was in Class A office, retail, and hospitality. But by the end of the decade, those assets were simply not performing the way that they had in the last cycle. Now, fast forward to today, those assets don't have a home. And with their loans maturing, because commercial real estate loans don't fully amortize like your single-family residence does, these have to go out and find new debt. But the debt isn't there. And worse than that, not only is the property not performing well, but as interest rates increase, when these loans come due, it's more expensive debt than it was before. Now let me talk to you about this. Many other asset classes have benefited through this downturn in the core blue chip commercial assets that we've relied upon historically for the last 100 years. These include mobile home parks, mini storage facilities, and small bay industrial warehouse, most of which are leased out to typical small mom and pops. These are folks who have traditionally not good financial backing. We're not talking about Fortune 100 organizations. Now, if anyone has seen the movie The Big Short, those assets were packaged off and sold into the secondary market as AAA rated, and yet they weren't AAA rated. We're talking about some of these assets that are in tertiary and secondary markets. Some are 40, 50 years old with a lot of deferred maintenance. But because investors were willing to pay the price, appraisers could go out and find the comparables and allow those to get funded. Some of these assets will not stand the test of time. And those of that investment tranche that will default will be packaged up and will hit at the same time many of the others that we talked about that are going to be maturing from the earlier part of the decade are going to start hitting late 4th quarter of 22 all the way through 2025. And that's assuming that we wait for them to go all the way through the lender default process. There is, however, an opportunity for congressional action, modifications to Fed policy, and new legislation that could account for these forces that have been set in motion by the pandemic to be viewed through a different lens. If we're allowed to do that, we could avoid all of this turmoil and chaos and not plunge ourselves and potentially the entire world and financial banking system into crisis like it was in the last decade. For us, we're preaching patience. And for those who plan to hold, it is critically important that you obtain new debt that can carry you into a period between 2027 and 2032. This is going to be something that's going to stabilize your assets. Now, for the record, I want you to know we're not doom and gloom about this, but we are simply talking about and identifying the forces that we know are at play, that we believe can create an incredible opportunity for sophisticated investors who will listen to cherry pick valuable and historically unavailable opportunities at tremendous discounts, giving you an opportunity to create generational wealth that really only comes around during significant market correction. But here's the thing. Whether the government does or does not react, it's important for you and us to be prepared. These are the things that matter. Now, I don't want this to occur, and I'm hoping that folks will listen. I'm hoping that someone in government that has the power will talk about the things that are already in motion to prevent this from happening. But it's not likely. There is no legislation that is already in process, and those things are going to start hitting beforehand. You see, we recognize that there's a substantial amount of investment capital on the sidelines. If the government will react, it's going to give us an incredible opportunity to stabilize these assets, and that's best for everyone. That's going to give us the opportunity to continue the market climb that we're on right now, allow us to deal with the assets that are troubled in a way that gives them, let's say, 36 or 60 months rather than 12 months. Now, we recognize that there's substantial investment capital on the sidelines, and we believe that that private equity and crowdfunding is going to fill many of the gaps if banks are forced to deal with non-performing legacy loans in a traditional manner. This is your opportunity to move and to strike while the iron is hot, and to not get burned by the forces at play. For those who are looking to learn more about this, you can reach out to us at commercialacademy.com. We're going to be there to help guide you through this process, to give you the support and the tools that we need, and to connect you into a network with potential resources to help you as you find new opportunities or potentially are looking to stabilize the assets that you have. I'm J. Scott Shield, the founder and president of the Commercial Academy, and I look forward to helping you on your journey through the turbulent marketplace that is sure to come through the balance of this decade.